Welcome to Sharpe Insights, Conversations with Your Plan Giving Experts, a podcast for development professionals. Whether you're new to the field or looking to enhance your existing program, we will provide practical tips, expert advice, and real-world stories to deepen your understanding of plan giving. If you're committed to securing long-term support for your nonprofit, you've come to the right place.
Welcome to Sharpe Insights, Conversations with Your Plan Giving Experts. I'm your host, Grant Miller. The One Big Beautiful Bill Act, or OBBBA, has the potential to reshape the landscape of charitable planning. With the law containing incentives as well as limitations for charitable giving, how should nonprofits prepare for what's ahead? In this episode, we'll explore what the OBBBA could mean for your donor's ability to make impactful current and future gifts. Our featured guest today is Phil Purcell. Phil is a 2025 CGP Hall of Fame inductee, the Director of Plan Giving for the Salvation Army Central Territory, and the editor of Plan Giving Today. Phil has guided countless nonprofits through the complexities of tax law, charitable tools, and fundraising strategies. Today, he'll help us understand the new law's provisions and what they might mean for the future of plan giving. Phil, thank you so much for joining us today.
Thank you, Grant, and my sincere thanks to Sharpe & Company.
Absolutely. It's great to have you. Well, I guess first off, can you explain briefly some of the highlights of the One Big Beautiful Bill and how it relates to previous tax legislation?
Well, the One Big Beautiful Bill Act is different relative to prior tax legislation in general, in that it instituted a number of very interesting changes, modifications, confirmations of various aspects that directly relate to charitable estate planning. There have been some massive tax charitable planning bills in the past, most notably the Tax Act of 1969, and others through the years that have been expansive. But in recent years, I would say, for much of the audience, this would be a bill that touches on a greater number of topics and new or confirmed laws that affect charitable and estate planning.
What are some of the key provisions there that affect charitable and estate planning?
Yes, and there are a number of these. Of course, one would be it made permanent the various income tax brackets that were in existence prior to the bill, but were slated to sunset. And when I say the word sunset, what it means basically is that these were provisions provided by an earlier law, many of these by virtue of the law of 2017. And so some of these laws were slated to sunset and then revert back to what, say, the prior law was in 2017 or whenever the sunset began. So if they weren't made permanent, they would have either sunsetted to their prior version or some other variation. Understand that every piece of law is, in a sense, editable by Congress. So in a way, while we may use the word permanent, at some level, none of this is permanent. It's always potentially subject to change. But I would hope, and I do think, that Congress generally considers laws as necessary guideposts to guide activity and tend not to want to make too many changes too rapidly, because that affects estate planning. We don't know what to expect and other aspects of planning. And so anyway, these new income tax brackets, 10%, 12%, 22%, 24, 35, and 37. It also instituted a return of a unified deduction, a universal deduction for all taxpayers. We've had that in the law before. We had it temporarily during COVID, but we now have a new standard deduction for everybody. It's available to everybody for $1,000, a single person, $2,000 married couple. We had the higher standard deduction, which was introduced, and it's been made permanent. And for 2025, that standard deduction is $15,750 for a single person, $31,500 for a married couple. And that'll be indexed annually now, every year for inflation. When I say indexed for inflation, that means it'll go up a little bit every year to account for inflation. So that standard deduction is something we can talk about in a few minutes and the impact that has on philanthropy. The 60% of adjusted gross income deduction limit for cash gifts, that's been made permanent. It was 60%, and then, in fact, before 2017, it was at 50%, and then was increased to 60, and then was slated to sunset. But now it's permanent moving forward after 2025. So 60% AGI, adjusted gross income limit for cash gifts, and that's very, very helpful to philanthropy. The estate tax exemption amounts that were slated to sunset have been made permanent, and that is now $15 million per individual, $30 million married couple, and only about 0.1% of estates are subject to the estate tax. So that's back in the day when I started in fundraising, the estate tax exemption was relatively low to the point that we actually proactively talked to a lot of donors about estate tax savings through giving, but that's not the case so much now with it applying to so few people. But even in those cases, it's 100% charitable deduction, so that's one other change. The giving threshold for itemizing. If you're going to itemize, now remember, because of the standard deduction, only about 9 to 10% of taxpayers now itemize. But for those who do, they've got to give a minimum of 0.5% of their adjusted gross income before they itemize. So that's a new provision, kind of a threshold before you can itemize. Then for the highest income people at the 37% tax bracket, their deduction is capped at 35 cents of each dollar beginning in 2026. So not 37 cents as you might expect at the 37% bracket, but rather 35 cents for those highest income taxpayers. Corporations have a new floor. They have to donate at least 1% before they can claim charitable deductions on corporate income tax returns. That's new. There are new higher tax rates on university endowments. So, Grant, as I said in my introduction, a number of interesting changes or the making of permanent changes that were there before, but are definitely relevant to philanthropy.
Excellent. Thanks for that. A lot to unpack there. I appreciate your explanation. I'm curious about some popular plan giving vehicles like donor advised funds, for example. How do the bill's proposed changes affect these types of gifts? Are there new opportunities or restrictions that development officers should know about?
Well, that's a great question, Grant. And of course, as we all know, donor advised funds are extremely popular, not only for those organizations that are sponsoring organizations of DAFs, but also the rest of us who are the happy recipients of donor advised fund grants. And well, as we all know, I think, or suspect, that a lot of the philanthropy of DAFs has been driven by, let's say, really large gifts in a given year to maximize tax deduction impact. So, for example, I may normally claim the standard deduction, but if I have a high income year and I decide if I have the opportunity to make a large gift above the standard deduction amount, so I itemize and claim a deduction, I could do that gift of either cash at the now permanent 60% deduction limit and or non-cash assets. And the deduction limit for non-cash, especially appreciated assets, remains at 30% of adjusted gross income, no change there. But I make those gifts to the DAF, bigger gifts. I can itemize above the now permanent standard deduction amount and maybe of a sufficient amount that I'm obviously above my new 0.5%, let's say, floor, so I'm able to itemize to claim that deduction. Then that DAF can grant in multiple years in the future. When you give to a DAF, you don't have to grant out of that DAF in the same year of the gift. And so I can add up or accumulate some money in a DAF that becomes available for pledging, and pledges can be fulfilled from a DAF. Or if my alma mater or my church or other charity is planning to have a big campaign in the next couple of years, I can store up some funds and make a big splashy gift to help the campaign kick off, that kind of thing. Or I can store up enough money to meet the minimum for establishing an endowed fund at my alma mater or another charity, or the minimum to achieve naming recognition, let's say, at a charity. So using the DAF and taking advantage of the ability to claim a deduction greater than the standard deduction, and that deduction's available for the year of the gift and 5 years of carryover. and I can make it with cash or non-cash assets. Blending of gifts, Grant, very, very important and popular topic. This idea that I can do both current gifts and even deferred gifts as part of my blending opportunity. Of course, as I alluded to in my opening, you mentioned restrictions on gifts, and important restrictions moving forward is that minimum of 0.5% of AGI, adjusted gross income is AGI, before I can do any itemizing. So you've got to do a little bit, make a certain level of gifts before you can itemize. And if I'm in that higher income tax bracket, my deduction will be capped a bit at 35 cents rather than the full 37. So those are some restrictions moving forward. But that's a great question, Grant. Thank you.
Well, thanks. That's a great answer as well. Given these changes are not really going to occur until 2026, how should organizations prepare donors for changes in 2026? And this is kind of a two-parter. More importantly, are there anything as we come up on year-end giving that organizations should focus on to encourage donors to give this year?
Well, the 0.5% floor before you itemize doesn't take effect till next year. So that's something to keep in mind. That doesn't kick in until next year. The minimum to claim itemized deduction, that 0.5% floor doesn't kick in until next year. So that might incentivize this year, of course, as well as what's going to be a new cap for the highest income taxpayers. They could front load their donor advised fund this year with a lot of gifts and take full advantage rather than having to be worried about either the 0.5% floor or the 35 cents on the dollar limit that'll kick in 2026 for the highest income tax bracket at 37%. And especially for those DAF donors, that's where a significant number of those DAF donors are in that higher net worth, let's say, category. I say this year and every year, people always, and this doesn't relate to the tax bill, but just to maybe give some comfort, nothing was changed in the One Big Beautiful Bill Act relative to the qualified charitable distribution or IRA rollover. So that continues, as is. It's 108,000 in 2025. It'll be increased next year. Now, remember, that is a cap regardless of whether you're itemized. So you may be claiming the standard deduction, but you can do those IRA rollovers, or also called qualified charitable distributions, up to the maximum. And by the way, IRAs are individually owned, not jointly owned. So if you're married, each partner can give up to the maximum from their respective IRAs. And of course, a couple of years ago, we had the wonderful new law. It's not part of the One Big Beautiful Bill Act, but it's still relatively new, of the QCD or IRA charitable rollover for gift annuities or charitable remainder trust. For a variety of reasons, more popular for gift annuities, but the maximum there is $54,000 per IRA owner. And there are other lots of spatial rules that we probably don't have time for relative to that QCD for a gift annuity or charitable remainder trust. So definitely some good strategies for donors to talk to their representative organizations about as they think about planning for 2025 to take maximum effect.
Okay, you mentioned some specific changes to older and high-income donors. And how might this affect giving decisions in the future? Do you have any insights or advice for how organizations might approach this moving forward?
Yeah, that's a really good question, Grant, because after the standard deduction was doubled in 2017, the Lilly School of Philanthropy that I'm a faculty member of did some economic research, as they do quite often, and they studied the impact of the higher standard deduction on charitable giving. And their conclusion was, and you can find these research results at the Lilly School of Philanthropy's website, was that in the following year or so, there was a decrease in giving to the tune of $20 billion with a B. So they saw a negative impact of the higher standard deduction. Now, people were claiming the standard deduction and not itemizing. And so that is a concern or a challenge I think all fundraisers need to think about. With only now less than 10% or so of all taxpayers itemizing, that phraseology we often use in our year-end publications, quote unquote, give before December 31 to take, your tax deduction for 2025. Well, that's slipping away because the vast majority of taxpayers are not claiming charitable deductions anymore. They're not itemizing to claim the charitable deduction. So that is of some concern. The Lilly School will continue its research, and time will tell if the higher standard deduction continues its negative impact on giving or not. Maybe we're just in a transition period, so to speak, and the hope is that giving will bounce back. But this idea of do tax incentives help philanthropy or not has been debated back and forth over time. There's been a lot of research on it, too, that does show some degree of correlation of giving to tax benefits, for sure. So the jury will be out on essentially how these will definitely impact long term. But overall, you sense obviously some limitations. The 0.5% floor before you can give. For corporations, it's a 1%. A corporation has to give 1% of charitable giving before it can claim additional deductions on the corporate income tax return. Now, the corporate income tax deduction limit is 10% of income, so it's much lower than individuals, but still, and then of course the cap, once again, on the highest tax rate taxpayers, all kind of represent, along with the standard deduction, kind of a closing in on the use of tax benefits for philanthropy. So again, time will tell to what effect any of this may have on actual giving. It's still obviously a little early to say definitively whether it will help or in fact hurt. But I think it's incumbent on all of us to remind all of our donors that our needs are great, our missions are important, and that their giving is needed and appreciated. I hope some of that background helps you, Grant.
Oh, absolutely. I kind of want to just continue on with this thread of conversation. You mentioned a lot of these changes are quote unquote permanent, but we all know that, as Heraclitus said, David Lee Roth might have said it better, but the only thing that stays the same is change, right? So I'm curious about the OBBBA is going to change the way that nonprofits engage with donors for the long term, but there's also, as you mentioned, changes in tax laws that happen more often than every 4 or 5 years. So how do you recommend that organizations engage with donors and talk with donors about these potential changes that might evoke some fears or trepidations in?
Well, I think one thing that is incumbent on all nonprofits to do is to really, really encourage their small dollar amounts, $1,000 per person, $2,000 married couple. But that's a universal deduction. It's a deduction that people claim for their charitable gifts regardless of whether they itemize. It's an automatic. And so we as charities need to heavily promote that, number one, and hope that it helps build loyal giving. I get the question a lot of course, in planned giving, we talk a lot about a focus on the baby boomer generation, the great wealth transfer and leveraging gifts, both current gifts and deferred planned gifts as well. But get a lot of questions about how are we engaging with millennials and Gen Xers and younger folks. And look, everybody knows that loyal long-term giving is the wellspring from which all planned gifts flow. And loyalty of giving is hugely important. And using the new $1,000 single person, $2,000 married couple universal deduction available to everybody is one way to incentivize and hopefully instill and support loyal giving. So when you talk about planned giving for the future, now this is a bit long-term future thinking, but we need to build the base of long-term loyal givers everywhere in all our nonprofits. And that new deduction will be, I think, helpful towards that accomplishment. So that's one suggestion I encourage everybody to make sure they take advantage of. Of course, when we think about deferred type plan gifts, the simple bequest and a will of trust is always king of the crowd, so to speak. And there are a lot of other great vehicles. We could always talk about gift annuities, share maynard trust, beneficiary designations of retirement plans for sure. But these revocable deferred gifts, simple will and trust bequests, again, beneficiary retirement plan, are very attractive for individuals. They don't connect to any of these specific tax law changes we've been talking about. These are ways to simply but very effectively plan for long-term gifts. So if people become weary of all the various nuances of these various current giving income tax caps and floors and limits and all of that, Always remember, don't lose sight of the importance of promoting and advocating for simple bequests and a will or trust, retirement plan beneficiary designations. These are going to be the fruitful sources of big plan gifts, especially, of course, right now with the boomer generation during the wealth transfer. And again, a third thing I think I would mention, Grant, and for everybody not to lose sight of, is the importance of non-cash gifts, especially appreciated asset non-cash gifts. And nothing has changed relative to those gifts. So a lot of changes here, but you always have to remember what has not changed. So remember, if somebody donates appreciated stock, publicly traded stock, very important to promote, or real estate that's appreciated, gone up in value, they will completely escape capital gains tax. The charity will accept that asset in kind. Charity will sell it, but charity won't owe capital gains tax, and the donor won't owe capital gains tax. Very attractive. And the donor can qualify for a tax deduction if they qualify for the deduction, if they're itemizing, let's say, and that deduction limit remains at 30% of adjusted gross income with 5 years to carry over any extra. So these deduction limits of 60% for cash gifts, 30% for non-cash appreciated property gifts, you get the year of the gift plus 5 years, 6 years total to claim that deduction. You can't pick the years for your deduction. You have to take as much each year as you can up to the limits. And there's a very helpful worksheet in IRS Publication 526. If you're blending cash and non-cash with different limits and you're near or over your limits, how to work through how much you can take of each gift in a given year. But we can't lose sight of non-cash appreciated asset gifts too, Grant.
Okay, so keep those non-cash assets in the conversation. Well, a lot of times when our policymakers, make new policies and create new laws and such, they will talk about the positive or negative ramifications of those. And sometimes it's up to us to read between the lines a little bit and I guess clear up any misconceptions or misunderstandings about these bills. Are there any particular misconceptions or misunderstandings that you've heard out there that you would like to address or clear up for folks?
Yes, there are always misperceptions, misunderstandings. You're not in plan giving very long before you realize that explaining a lot of this is an ongoing, never-ending activity. And so I would encourage all those listening to this podcast to just make sure they understand the rules and then in the easiest, most straightforward ways, seek to explain them using webinars, print materials, and I know Sharpe can help with all of that to help articulate this information as clearly as possible. But my friends, it's a long-term activity. It's not like you're going to send one flyer out or have one donor education webinar or one seminar for professional advisors, and then you're done. I mean, we're going to be answering questions about these for a while. And so having accurate material at your ready, very important. Putting this information in newsletters, flyers, mailers, very important. And having it on your website, very important. All good ways to disseminate good information. Now, I've heard different kinds of misperceptions, like are the tax benefits for philanthropy going away? There's been, for some people in their mind, an overemphasis that maybe Congress is slowly doing away with tax benefits for philanthropy. And, while there are a lot of changes here, I don't necessarily see the hallmarks of a definite trend to eliminate tax benefits for philanthropy. They're still there. In some cases, some of them are new, like the new universal deduction for $1,000 and $2,000. It's my sincere wish that universal deduction will increase over time. And that's another thing I encourage our listeners to consider is either singly or in combination with other charities, try to lobby for expansion of these things, these provisions to make them even better. That's not an easy task. There are national associations like the National Association of Charitable Gift Planners that are active in this realm, and AFP and CASE and other national associations. But point being that we all can play a role in assuring that the use of the tax benefits is helpful and appreciated. I hope those are perspectives that you find helpful.
Absolutely. And, in the long term for development officers, it sounds like it's important to stay involved, stay in the know, communicate, and just continue to build these relationships with donors.
Absolutely. And, the most important thing of all, of course, through all of this is there is a famous author in philanthropy called Cy Seymour, long past, but not forgotten. Cy Seymour had a quote that talk of taxes is rarely fundraising's best opening move, but obviously the talk of taxes can affect the timing of a gift, the type of asset used for a gift, even sometimes the dollar amount based on available deductions and so forth. So while it may not be the opening move, it's certainly something that we can't ignore either. So that's why listening to this podcast, learning some of these rules, and then getting good material to help answer questions is very important. But above and beyond all of that, I think all fundraisers know it's all about the relationship. It's all about the conversation. And only through the relationship and the conversation can you then maybe become aware of confusion, or maybe aware that they're not familiar with some of these new rules or the permanent aspects of some of these rules, and that you can clear up and help them do the best possible charitable planning.
Phil, thanks so much for clarifying this complex bill. Is there anything that we haven't talked about today that you'd like to add?
I think we've done a good job of covering the bases, and I just would encourage everybody to take note of the various changes that we've discussed today and do your best at understanding them and being able to talk about them. With practice, with additional conversation, with answering questions, you'll become more facile and capable with feeling comfortable and confident that you can address these opportunities. But continuing on the themes that tax benefits for philanthropy are still alive and well. There are some nuances to be mindful of now. Be sure to always think about blending gifts, weaving in the non-cash, appreciated non-cash opportunities. Don't ever forget the IRA charitable rollover that saves taxes even if you don't itemize, which is a wonderful thing for those aged 70 and a half and older. So those IRA rollover rules are still there and not changed by the One Big Beautiful Bill. It's easy to focus on what's changed, but you can't forget what's not been changed. And always explain and enhance the importance of revocable deferred gifts that are a very important source of revenue. And as I said, just keep that relationship going and the conversation going so that you're best positioned, because timing is a funny thing, and you never know when the right time is for donors to necessarily plan that big gift. And that's where, for example, the donor advised fund could be so handy. They can take advantage of some of these new tax benefits or the adjusted tax benefits to maximize the gift in a DAF that you can grant from long term. So anyway, Grant, those would be my final pieces of advice, I would say.
Phil, thank you so much for that wrap up, and thanks for being on today and for sharing your experience and expertise. And thank you for listening to Sharpe Insights, conversations with your plan giving experts. If you found today's episode valuable, please subscribe, share it with your colleagues, and as always, reach out if you have any questions or topics that you'd like us to cover. Until next time, I'm Grant Miller.
Thanks for listening. We hope today's discussion gave you practical takeaways to grow your plan giving program. To submit questions and topics for future episodes, go to sharpegroup.org or listen to us on your favorite podcast app. If you found this podcast insightful, be sure to like, review, and subscribe. Until then, stay sharp.